Hello everybody and welcome back to the channel. In today's follow-up video on some of the hydrogen stocks that we have covered previously, we have gotten quite a few requests on whether we could do an update based on the most recent fundamentals of Ballard Power Systems, Fuel Cell Energy, Plug Power and Bloom Energy, which we have covered in a lot of different videos, and we thought, okay, now it's a few quarters since we did the last video and it may be a good time to see if anything has changed. Obviously the share price of some of the companies, more specifically Plug Power and Fuel Cell, completely exploded over the last 6 months time. You can see here that Fuel Cell Energy is up with more than 1000%. It then settled down at around 480, Plug Power 192, and then you have Ballard Power and Bloom Energy with around 60%. So all of the hydrogen stocks got a massive increase based on the lot of news that you got around the world about governments who are going to invest a lot of money into hydrogen stocks. And now we're going to see, okay, has any of the company's fundamentals in itself changed? Has revenue gone up? What is the net income? What is the financial situation of the companies? If we take a look at the revenue and profitability, by no surprise, all of the companies are having a net loss over the last 12 months, and this is expected to continue in the coming years. Plug Power and BE are probably the ones that is going closest to green numbers in the coming 2 to 3 years. Approximately, that's at least the ambitions. Net margin-wise, Bloom Energy doing the best with only minus 20%, Fuel Cell the worst with minus 137. It's not so interesting to look at that. We think it's more interesting to look at a long-term picture. So if we take a look at the revenue for the last 5 years, we can see BLDP here. It has remained relatively flat. It has gone a little bit up, a little bit down. Fuel Cell, on the other hand, has been in a downwards trend. It went up a bit in 2020, but with the first Q results they just announced a few weeks ago, we know that the revenue disappointed here, only around 15 million. So again, if they don't start to increase this, obviously Fuel Cell revenue is going towards a downwards trend again. Plug Power, much better, as we can see here, year over year. There's constant increase in the revenue, and for 2020 we only have for the 3 first quarters, so we're missing the last quarter to add to this, which means that if you put on another quarter, you should expect to have a revenue growth over the full year compared to the previous year. And similar with Bloom Energy here, we can see a quite significant increase in the revenue for the past few years. However, in the last year, it only increased slightly. From a net income trend perspective, BLDP, we can see here net loss is actually increasing. So obviously here we want to check their balance sheet to understand how strong it is. Similar with Fuel Cell, they're losing more money. As you can see here, quite significant loss in the most recent quarter. Plug Power has been a little bit more stable, but they're also losing a bit from a trend perspective, a little bit more than they did in the previous years. And Bloom Energy has also had relatively high losses, but considering the revenue, it is not too bad. And as we can see in the full year of 2020, they have actually decreased this quite significantly. And if we take a look at the projections for the coming years from a revenue and EPS growth perspective, we can see that revenue, all of them are expected to grow. Fuel Cell only 3%. So again, this just illustrates that, you know, the trend for Fuel Cell is not going upwards like Plug Power, where a 54% increase is expected. There's a target between $435 to $495 million for 2020, and Bloom Energy is also having a healthy growth of around 24%. From an EPS perspective, we only have for BE here, and they're estimated to improve with 25%. So they're obviously still going to be in the negative, but it's still good to see that they are at least improving their profitability. So if we take a look at the return metrics, we're not going to spend too much time on them, obviously, because they're not that good when looking across the board. But it's worthwhile to mention that BE is probably doing the best overall, followed by Plug, BLDP, and Fuel Cell is doing the worst. Looking at return on assets, return on equity, they're also pretty bad on return on invested capital, and the free cash flow yield is neither that good. If we take a look at the shareholder yield, obviously none of these companies are paying any dividend. No surprise there. A lot of the companies have taken the opportunity with the increase in their share prices to raise more equity to cover losses and to fund future expansion, perhaps construction of factories. So BLDP has a minus 10.9, minus 7.7% on fuel cell, minus 3.3% on plug, and only 0.5% for BE. So no significant dilution on their side. And obviously we would expect this to be reflected in the balance sheet. And taking a look at the balance sheet across the board, perhaps with the exception of Bloom Energy, it's looking quite well. BLDP has a cash ratio of more than 14.7. Usually we would like this to be above 1 or so. So again, that is quite fine. Obviously, we want a bit more for these type of companies because they have losses and they have had losses over several years. Fuel cell can run on the total cash and short-term investments for a little bit more than 3 years if the losses is as they are over the last 12 months. However, as we have seen, fuel cell losses have increased over the years. So again, it may be within a foreseeable future, fuel cell will have to raise more equity in the market, and you should be aware of that. Similar with Plug Power, they have pretty ambitious expansion plans, and we also therefore could foresee that they may go to the market again. And similar with BE, we saw that there's an expectation that the EPS is going to improve over the coming years, but by no means we think that they will become profitable in the near-term future. So again, it could also be in the cards for them to raise more equity, so please keep that in mind. And if we look at some of the other metrics, debt equity ratio, and also the Altman-Set score, which is obviously a credit strength test that assesses the likelihood of bankruptcy. We want in general this number to be above 1.8. And looking at BE, this is really dire numbers. We're really not happy to see that. In general, when we see such numbers, we're going to stay away from a company like that because it is so high. However, we would say that BE could probably go to the market and raise some equity again because there's a lot of hype around hydrogen. There's a lot of hype around them in general. So again, that would obviously improve their balance sheet, but we would say it doesn't look too good from what we are seeing on those two numbers, and that would generally be a no-go for us when looking at that because obviously there's a high indication that their financials are not good enough. If we take a look at the P ratio and the forward P ratio, they're all expected to post negative results in the coming 12 months. Price to sales ratio, this was something that we covered in our separate video. And as you can see here, they are relatively high. You know, BLDP 50.96, it's quite extreme. If you see a company like Tesla, they have, I don't know what it is exactly today, but when we did the last video, it was around 28. And again, some people are saying that Tesla is completely out of the world in terms of their numbers, and then look at BLDP, fuel cell, and also plug at 34.41. It is just extremely high. Here BE looks a lot more realistic with 4.62, and I know some people may come and say, Bloom Energy is really not a hydrogen company like the others. And although that is true in a certain sense that Plug, for example, is much further ahead on their hydrogen journey, BE is in a transition into turning in their servers into this, as we covered in our separate video. But still, BE is considered a hydrogen company as of today. So again, looking at the price to sales ratio, these companies just looks extremely expensive. Also considering that the revenue is not expected to increase with huge amount of growth. It was 12% for BLDP, fuel cell was 3%, and plug was then 54%. So from their perspective, it is at least a little bit more justifiable. So if we take a look at our own estimated intrinsic value of these companies, I guess it's by no surprise to some of you, we missed the run-up in these companies. We saw that there was a huge push for hydrogen on a worldwide scale, but we didn't thought that would impact the shares in the way that it did with the extreme growth that we have seen. So we missed the train. That was obviously a mistake on our side. But nonetheless, we still overall feel that a lot of these companies is extremely overvalued. And what we are seeing is that there's at least a 20% downside on BLDP, 72% on fuel cell. I know a lot of you would not like to hear that, and probably we're going to get slammed in the comment section. However, we cannot see anything in fuel cell that justify the massive growth that they have seen in their share price. If at least revenue had gone up considerably, or they did a lot of announcement with partnerships or deals that they have entered into, but honestly, over the last 6 months, that has not been the case. Plug Power, although we think that they are overvalued, as you know, they're one of our more favorite companies in the space at the moment. We just think that they're overvalued. But at least what you're seeing with Plug, is that they are entering into a lot of deals around the world. It comes on a continuous basis. Every week there's a news around Plug has entered into a partnership or deal with some other company. So at least with them, again, there seems to be a trajectory that's going upwards. Then we know some of you may say, yeah, but they have just gotten a warning from NASDAQ that there was problems with their financials, and obviously that was not good. But as far as we understand, it was non-cash balance related things which shouldn't have a huge impact in the long term. So again, although it was not good, it's not something that is a huge concern for us. But we still see Plug as being overvalued with 44%, and Bloom Energy is the one, according to us, that has the least downside with only around 12%, where we think if it hits that, it starts to become more interesting. From a book value perspective, they're obviously all overvalued, and from a relative strength index, a lot of them have been beaten down over the past months. But there's no clear indication as to whether they will go in an uptrend or a further downtrend. If they go below 30, this will be a technical indicator that they may go on an uptrend again. So BLDP is closest to that, but none of them are really close to 30 yet. Finally, we can take a look at what the analysts are saying, and here you can clearly see that we are quite in a disagreement with a lot of the analysts. They're quite bullish on BLDP. They see a 37% upside. Fuel Cell, they're a bit more pessimistic, a 36% downside, and upside on Plug on 57%. Again, in our opinion, that's just extremely crazy. From what we're seeing, we know revenue is growing, etc., and they are an interesting company, but we just don't see such a big upside on them at all. As you can see, we see a quite big downside on them, and this here a small upside on 8% of Bloom Energy. So again, quite a disagreement with what the analysts are saying, but it's our perspective, it's what we are seeing, and obviously we have been wrong in the increase of the share price that has happened over the past 6 months, but we just don't really feel it's justifiable, despite all the positive news from or ambitions from a lot of the governments around the world. So here just the overall ranking of the companies. If we looked at the trend, all of them in our opinion in a downtrend. The net income is obviously negative. From a net income margin perspective, Bloom Energy was doing the best with only minus 20%, while as Fuel Cell had a minus 137%. From a revenue trend, BLDP is stagnant, Fuel Cell is decreasing, and both Plug and BE is growing. From an earnings trend perspective, BLDP and Fuel Cell is decreasing, and Plug and BE is more or less stagnant phase at the moment. From return of equity, BLDP was doing the best, followed by Plug Power, while as in the return on equity, invested capital, and free cash flow yield, BE was doing the best, followed by Plug. Shareholder yield, we have let that one out. As you saw, a lot of the companies have taken the opportunity to raise more equity, so they're all minus, and some of them will most likely in the coming years have to raise more equity to cover their losses or to fund their growth. From a cash ratio perspective at the moment, and total ratio and debt equity, BLDP and Fuel Cell is looking the best, followed by Plug. It's quite a concern on Bloom Energy, but again, given that we think that they will be able to go to the market and raise more equity if they have to, we are still not too concerned overall, but again, it's something that you definitely want to take notice of. BLDP and Fuel Cell obviously had good numbers because they have increased a lot of equity in the market over the last 12 months. And finally, an overall value assessment. We think that all the companies are overvalued, and we don't think there's a good buying opportunity in them as of today. So again, what is the overall verdict? Well, they still appear very expensive in our opinion. If we take a look at BLDP, no growth over the past 5 years. They have a strong balance sheet, but they do not appear attractive at these levels at all from our side, so we are not recommending them. Similar with Fuel Cell, they have reduced revenue and income in the past 5 years. They have taken the opportunity to raise more cash, which was obviously needed for them. No significant revenue growth expected in the coming year. And again, with the Q1 results that they just launched a few weeks ago, again, there was just nothing that gave us a warm fuzzy feeling about them, so we will definitely not recommend them. Plug, we would put them on the watch list. They have still delivered strong growth in the past years. They have still decent balance sheet and growth expecting moving forward, but still overall 20 billion market cap just seems a bit too high from us, considering the revenue that they have on an annual basis, despite the growth that they're seeing. We just don't think that is attractive, but we would say put them on a watch list and perhaps move into Plug if it falls further down. Finally, we have BE. relative strong growth. We have some concerns around their balance sheet, and we would expect them to go out to the market and raise more cash in the coming year or so. They are not attractive at the moment, but they could become. It's not a significant drop that needs to happen in Bloom Energy before we would consider to move into the stock. But as of now, we will definitely stay on the sideline of all these companies. What do you guys think? Do you think that this is correct? Do you think that some of these companies are being unfairly treated by us, or do you think there's a better upside to them than what we are seeing? Please let us know in the comment section. Please give us a like if you like the video, and please subscribe for future content we send out quite regularly. Please keep in mind that we are not professional financial advisors, and this is only done for entertainment purposes. You need to do your own due diligence before taking an active investment decision. Besides that, there's not much more to say than stay safe, have a nice day, hasta la vista baby.